Good afternoon. This is Ken Long from Tortoise Capital with a review of the trade of the day for March 14th, 2013. So we've had a market in the last 40 days that's been doing nothing but going straight up, making new highs, low volatility, very narrow Bollinger Band range. So strong bull, normal, and at times bull quiet move up. So we have a long side bias until proven otherwise, and we want to emphasize the relative strength leaders on days when the market is going up, believing that winners will continue to win, and we'll see how that shakes out here in a little bit. So early this morning, with our long side bias, the blue lines are when the market opens up. This first chart is HPQ, which has gone from being the worst member of the Dow 30 over the last 6 months ago to the best performer in the Dow in the last couple months, and so that's a high relative strength candidate. And so if it's going up more than the market's going up, then that's a good reason alone to buy it. That's all you need really to know. And this is TNA, also on 3-minute charts. They're both on 3-minute charts. That's the triple leveraged Russell 2000 small caps. The blue area in the middle is the 30-period Bollinger Band plus or minus 1 standard deviation. Black line is a 30-period regression. Blue line is a 10-period regression line. Purple steps are the volume-weighted average price. This red line in the middle is the middle of the river. Blue is when I'm stalking it. Red lines are how I'm managing stops. Green circles are entry points, and we'll see red circles when I exit later. So we had the market closed in HPQ about 21.35. It opened up at the same level, found some support for 1, 2, 3, 4, 5 3-minute charts. So for 15 minutes, it stayed above the Bollinger Band mean. Then price ribbon leaves the river, and we get our entry at 21.40 with a 20-cent stop, which is now this one only reflects 10 cents, but I don't like being closer than 20 cents on individual stocks, and so that stop for position sizing purpose was 20 cents, but really a reversal of 10 cents here would have gotten me out because then it would have failed below the VWAP and below the Bollinger Band mean. So for accounting purposes and position sizing, we'll use a 0.2 I stop, even though 0.1 is kind of indicated. So right after we buy it, we get a nice range expansion and price moving up to 21.50. Pulls back to the edge of the river, finds support where it's supposed to, north of the VWAP. Then the 30-period regression line never even gets into the river, which is sort of that's the dominant trend indicator in my view. Here's where it crossed the Bollinger Band mean the previous day. That gives us an upward bias. So it pulls back to where it ought to. It then takes off. When it clears the price ribbon at 21.50, I'm stalking a re-entry. I decide to re-enter at 21.55, or actually not re-enter, but add a second position, 21.55, and then it takes off. So right here at about 10:42, about an hour and 10 minutes into the session, we've got two positions in hand. Price at 21.60. That's about 1.2 R. On a double position, and then the stop is locked in to make sure that we are going to get at least 1 hour out of that. In the triple Russell, we get it's essentially the same idea, only there's a little bit of a gap up, whereas HPQ did not gap. This one, small gap up, and then takes off. And when it clears the VWAP and starts going, we've got the ribbon, the 10, the 30 period, almost out, 30's almost out of the river, but it made the crossover here. I like the upside. There's no resistance overhead. So we get our first entry at 87.80 with a 30-cent initial stop. Moves up, makes a nice move up, pulls back to the VWAP at the edge of the river. Doesn't even get near the Bollinger Band mean. Takes off. If I was better, I might have gotten a second entry here at about 88.50. But I get it at 88.60 in this cluster. Not a very good fill. But again, at about 10:42 in the morning, we get two positions on. So there's my 4 bullets. I've got I'm all in with 2 positions on 2 different symbols. So that's my span of control is 4, and and we're looking to be in pretty good shape. The Hewlett-Packard trade unfolds nicely. We got a nice spike up here, pulls back again, stays north of the Bollinger Band mean, makes a final run here, getting towards lunch at 12:30. It pulls back to the Bollinger Band mean. Regression line crossover occurs. 2165 is a reasonable place. So on initial entries at 2140, 2155, we got at 2165, and that nets out 1.5R. Shortly thereafter, the triple Russell trade also comes to a halt. Here's the two entries we saw in the previous chart. Continues to kind of grind northward. Then we get a strong regression line crossover here. Prices dipping sharply into the lunch hour. Go ahead and take it at 88.70. If I was better, I would have been up here around 88.95, but I wasn't. So, just got to work on that. So that's 88.70 is the exit. Bad fill, but on the two positions we net 3R. So this is what Hewlett-Packard looks like. Now, we just saw some charts that were looking at intraday in 3 minutes, but if you dial it out a time frame and look at hourlies instead in 4 weeks, this is what that looks like through the RLCO frame, or that lens, that framework for action. That's what relative strength looks like hour by hour. This has been a very powerful move from really when it gapped up from 17 to 19, and then and people, well, it's done. No, 19 to almost 22. That's another $3 on 20, which is another 15%. So that's what relative strength looks like on an hour-by-hour basis and over a 4-week period. Sometimes you can get caught up in the intraday trade and miss this persistent day-over-day performance that can help you out. So if you have something that's moving like that, and then you can dial into the intraday, and the market's going up and your target's going up faster than the market, you can actually start buying that just on that amount of information alone. If you then dial out further from hourly and then go to daily over the last 3 months, this is what the move looks like from 13. It actually went from 11.5, but here's 13 to almost 22, and that's $9 on 13. So that's pretty good. That's a pretty good move. That's about 60 or 70%. And notice the 30-period regression line on the daily never even comes down and tests, but now you got a sideways quiet channel here for a nice entry around 17. That's what relative strength looks like on a daily basis. If we go back 6 months on dailies, what I want you to notice is is key moments where the 30-period regression line crosses the Bollinger Band mean and then sets up this long trend from big thick circle to big thick circle. That's a move from 19 to 12.5, and then the signal at around 13.5, you get a signal that might be over because you got a regression line crossover here, price ribbon entering the river and then crossing the river with strength. Then the pullback stops at the Bollinger Band mean. By the time it does that, notice the slope of the 30-period regression line, how the river itself has changed. It takes that much adverse price information to change the downward momentum and slope of this move, which created that Bollinger Band and Bollinger Band mean. So now this is an important signal. Then when the 30 crosses the Bollinger Band mean, you get leaves the river. If you buy this one with a stop below the Bollinger Band mean, you stay in this entire trade. So then the pullback comes right where we would expect it to come, to the Bollinger Band mean, and if it finds support there, we shouldn't be surprised because that's what the mean is. And then it takes off, and now if you're a lazy W trader, you have a long, powerful downtrend. The first move up, pullback, creates a higher low, and then takes off again. Price leaving the river is a massively good signal after this long run. Nice move, pullback, measured pullback, takes off again. An entry around 15 is awesome. And then very quickly it runs up to 18, which is 3 on 15, which is 1/5, which is a 20% move in about 2 weeks. Again, an orderly pullback holds above the Bollinger Band mean. You get a sideways quiet channel, then an explosive breakout here. you have to have been in that position because that was a gap. But even from the gap, and really the 30 period comes back and finds support here at the Bollinger Band mean. Even the move from 19 to almost 22 is 3 on 19. That's 1/6. That's about another 15% move available just from the move after the gap and up. So this is what relative strength looks like on a daily basis. When Hewlett-Packard was getting crushed in here, it was the absolute worst performer in the Dow 30. Stayed that way for months at a time. In here, it started moving up our quality charts, giving us some tactical signals, and by the time it gets up into this next leg up, you're looking at the strongest stock in the Dow and stronger than 95% of all exchange-traded funds as well. So when you get these long kinds of moves like that, and you should be interested in the relative strength leaders. And so this is a quick look at my intraday screen, looking through the relative strength lens, and then using a watch list with key tradable targets. Everything on this list is there for a particular reason. It's tradable, it's liquid, it has an inverse, it gives me insights into market sectors and segments and how they're doing. And what I do is I stack it by this percent changed intraday, from, in this case, highest to lowest because I was going long. So the first thing I do is I find SPY, the market itself, and then I know anything that's improved over SPY, anything north of SPY, has by definition a better relative strength today. And so what I notice here is that 3 of the 4. Well, let me just start at the top. On an up day in the market with no resistance overhead, you'll notice that the relative strength winners continue to win. Hewlett-Packard in position number 2 is the single best performer in the Dow, near the top of the stack of these symbols, and continuing to drive north. That light blue is an indication of at a new high of the day. It's already up 2.6% when the market itself was only up 0.5%. So you can buy strength when you see it moving faster than the rest of the market, especially when the market itself is up. So you get the market juice, you get the sector juice, you get the company juice. So that's all good juice. XIV is the next one. That's the volatility off ETF, the inverse of VXX, and it's coming in at 2.2 when the market's at 0.53. 3 of the 4 new ads from the ETF2 database, which is based off of 3 and 6 month relative strength, are outperforming the S&P right now. That's IYT, the transports, continuing to do well. THD, Thailand, and PSP, the private equity. All of those are doing well. And the ETF2 is a reliable, reasonable way to find relative strength candidates from among a population of trading vehicles. And that can be enough of an edge to help you out. Only Philippines is underperforming the S&P right now, so lots of winning choices. And meanwhile, we're looking at I will look at IWM, the Russell 2000, and compare it to the SPY. So the Russell is at 0.94, the S&P is at 0.53. That tells me it's a risk-on trade, and the small caps are continuing to outperform the large caps. And if the small caps are attractive, then the triple small caps are really attractive. And so TNA is at the very top of the list, turning in a performance at that moment at 2.75, which is one of the reasons we were long it that day, today. Meanwhile, losers continue to lose. For example, in up markets, volatility declines, and so XIV is doing well at 2.19. And the losers continue. CLF, Cliffs Natural Resources, one of my favorite trading vehicles, is down large, and on a swing basis, it's the worst performing stock inside the S&P 500, according to Stock Charts. Scooters, the new relative strength metric that they're putting up. So it was the worst performer in the S&P 500. And on a day when the market is up, Cliff Natural Resources is down almost 5%. So when it fails through new lows of the day, that's when you want to be short at that moment. So that gives you an area to start stalking the short side. At the same time, I'm prepared to keep that on the radar screen because when it's through being punished, and it's gone from 45 to to 21 here pretty quickly, when it's done getting punished, then it's a candidate for what we're calling the washout type trade, in the same way that 5 months ago Hewlett-Packard was the worst Dow 30 performer and then started turning it around and marching northward, and we were able to start incrementing some cash into it on an intraday basis, using those wins to fund the swing trade basis with market money, and then letting the swing trade unfold once we're in the money. So this is of the 1,500 ETFs are out there. You don't need all of those on your screen. This is a handful of symbols that I'm prepared to trade. It has key index, both domestic and foreign, to give me insights into market conditions. It has small caps. It has finance. It has the transports. It has high relative strength ETFs. Now, if we ran the report right now and found maybe some different things near the top of relative strength, then I could find the ones that are tradable and then maybe import some of those into this watch list, which is just a handy way to array my targets during the day. So that's Ken Long from Tortoise Capital with a review of the trade of the day and some thoughts on relative strength and how to bridge the swing trade time frame and these longer, mature, persistent, robust trends with some of the techniques of intraday trading that allow us to, start harvesting things with relatively tight stops. So take good care, and we'll see you in the chat room. Keep your powder dry and your risk measured. Cheers.